Hello, everybody, and welcome to another episode of the Amicable Divorce Network podcast. I'm your host, Tracy Ann Moore Grant, and I'm the founder of the Amicable Divorce Network. If you've been following along, you know that season 2 of the podcast is going chapter by chapter through our new book, Divorce Amicably, Your Roadmap to Resolution. And there are 80 total chapters, and we have reached chapter 64, which is a very important one. And I hope everybody takes a moment to listen because we're going to be talking about taxes. And I am joined today by Georgia attorney Jason Wiggam, who is a tax expert. I am not a tax expert. I'm a family law attorney. Jason is a tax expert, so we're going to have him talk about these issues, and he wrote chapter 64.
Hey, Tracy, thanks for having me.
So one of the things that I think clients don't realize is that their family law attorney is not a CPA, is not a tax attorney, is not a tax expert. Unless they have some sort of specialization in that, generally, they shouldn't be getting tax advice from their family law attorney. Thoughts?
I agree with that. I think you want to make sure that you're getting the correct answer, the correct advice. Taxes are complicated. A lot of people don't understand them, and I don't think a lot of it's very complex. I think it's just they, don't, sort of when they see taxes, it's something that's just they don't know, they don't want to deal with, and I think that's even the same thing with clients too, right? They will sort of put their head in the sand sometimes, and unfortunately, when you're going through a divorce, there are a lot of tax issues that need to be resolved. Some of them are pretty simple, but others are more complex.
So one question I get all the time is, if people got divorced, let's say somebody gets a divorce October 1st, 2025, how do they file their 2025 taxes?
Sure.
What's their status?
The divorce was final in 2025.
Yes, say it's October 1st as a random date.
They are no longer filing as married. Whatever year the divorce is final in, you now file single or head of household. If you have a dependent, any year that you're married before the divorce is finalized, you're either married filing jointly or married filing separately.
So I always look at what will your status be on New Year's Eve, December 31st, 2025. Are you single? Are you married? And that would guide the taxes for the year.
That's exactly right.
Yeah, a lot of people have a misconception that they would sort of partially file one way and another way, but it's really an all or nothing.
Correct.
What about alimony and child support? What are the tax consequences for either of those types of payments in a settlement?
Sure, I'll do child support first because it's pretty straightforward. The receipt of child support is not income, and the payment of it's not deductible. So it's kind of a tax nothing, kind of like a gift. Alimony is a little bit more complicated. It's currently treated the same way. But before 2018, and I don't know, I would say maybe in 5 or 10 years, I won't even have to talk about pre-2018 anymore, but you do have people who are divorced that are maybe still paying alimony with agreements from before then. But before 2018, if you received alimony, it was income to the recipient, and if you paid it, you could deduct it against your income. So it was a little different, but that is no longer the case.
So if you got divorced 2017, 2018, before the law changed, you would be under the old law.
Correct.
If you've gotten divorced recently, you're under the new law where it's a tax neutral event.
Correct.
Now, what you're talking about in regards to alimony and child support, I know you're a Georgia attorney, but are these rules true for all states?
It is, yeah. So it's federal tax law, so it applies in all 50 states.
We get that question a lot as well. So now let's get into property transfers. A lot of times in a divorce, somebody gets a car, they're transferring it, deeded land, a house, different things like that. What are the tax consequences that people often aren't exploring?
So generally, transfers in a divorce case or incidents of divorce are tax-free. If I sold you my house, Tracy, that's could be a taxable event, right? But if we were going through a divorce, it's treated differently. It's treated like a gift, but you take the tax attributes just as you would a gift. So what that means is, let's use a house for an example. Let's say I bought a house for $200,000 and it's now worth $500,000, and I owned it outright, but my spouse ex-spouse was awarded in the divorce, she gets this $500,000 house tax-free, even though there's a built-in $300,000 gain. And let's say she turns around and sells it a year later, you can exclude $250,000 of capital gains if it's your primary residence. Actually, let me correct that. She sells it 2 years later, not 1 year later.
Okay.
You got to wait 2 years for that exclusion. Basically, there's a $300,000 gain, $250,000 of it's excluded, so she would have a $50,000 tax liability. So while the transfer, the awarding of the house to her and the divorce is tax-free, what she does with it later can have tax effects. So it's definitely something that people should, look at and keep in mind. But like if a car is transferred, if any other property is transferred, it's generally going to be tax-free. The thing though is there is a time frame. So if you're awarded something, you need to get it transferred within a year of when the divorce is finalized. So that's the other big trap I see people falling into.
Does that include K accounts, IRAs, things of that nature?
I am not an expert on quattros and the time frame on them. I think maybe there was someone else who did a chapter on it.
I'm only asking because that's the one area where I see people really delay is like I'll have a client and
it is different. I think you have more time. And obviously, if you're awarded a retirement account, you want to go through the specialized process to get it transferred because then it's tax free. The qualified domestic
relations order,
quattro, and if not though, like if I just distributed the money to my ex-spouse, it's going to be taxable to me. So that's why I want to go through this process. So retirement accounts are different.
I've seen so many people just delay in doing things, whether it's a car, a house, a 401k, to their detriment. Somebody changes jobs, something happens with an insurance claim. So it's really important to tie up these loose ends, I would say, as close to the divorce as possible.
For sure. Most of what I do is resolve tax problems for taxpayers with the IRS. So I've seen situations where, you're awarded the house, you didn't transfer it for whatever reason, we're all busy. And then the prior owner, the former spouse, has a tax problem and a tax lien gets filed, and now we have a real issue. So I think under one, to save taxes, but two, just to avoid issues, you want to do it as soon as possible, soon as feasibly possible when your divorce was finalized.
Yeah. If it's okay, I want to touch back on an issue and talk about it a little bit further that you brought up, because I really fundamentally think that people don't understand this, and that is the tax gains on the home equity. Because what we are seeing in the real estate market, of course, is even if somebody bought a house 5 years ago, the increase in equity is substantial, just passive, just being in the market. They bought a $350,000 house and now they can sell it for $600,000 just because things are increasing so rapidly. And I think when people negotiate to get the house, they really aren't considering that they will get popped on these capital gains, whether they sell it, unless the tax laws change, whether they sell it, 5-10 years later. Is it based on your tax bracket, what you get hit on capital gains, or is it a flat tax amount on that?
Sure, yeah. Like regular ordinary income, there is graduated rates with capital gains. So, what that means is there's a higher rate, the more income you earn. I do not know the exact amounts off the top of my head, but there's a 0% capital gains rate up to a pretty low threshold. And then after that, and by the way, I'm assuming long term here. So there's short term is you held the asset for a year or less. Usually with the home, it's over a year. Long term is a year or more, and it's a lower rate. So there's a 0% rate up to a very low amount of income, and then a 15% rate kicks in for a while, and then once you get to a couple $100,000 in income, a 20% rate kicks in. Okay. And sometimes there is an Obamacare 3.8% tax that can come into play too. Okay. But for most people, they're paying 15 or 20%. No one likes to pay taxes. That rate is lower than your normal ordinary income rate typically. For real estate, if it's your primary residence, there's a special exclusion. So if you lived in the home as your primary residence for 2 out of the last 5 years, you can exclude $250,000. If you're single, if you're married, it's $500,000.
Okay.
But a lot of people who sell historically didn't pay tax on it because that exclusion protects them. But to your point, the real estate market has been very good. A home is typically an emotional asset. You raise your kids there, you've lived there, you want to stay there. And I get that. But when, to your point, Tracy, when you're negotiating, is definitely something
you need to factor that in.
Yeah, you're benefiting the other party by removing a capital gain they would otherwise have to pay,
So let's say in this example, parties are getting a divorce, wife keeps the home, gets it in the divorce, and she later remarries. Now, because she is married, does she get to deduct the $500,000 in capital gains, or does it have to be the original marriage person?
No, you can deduct.
Okay. So you could just go marry somebody for $250,000 and get a tax break.
Yeah, no, I guess.
Get a prenup. I'm not advising this. I'm just sort of looking at some solutions here.
Yeah, I don't know that I guess it's what, 50,000 in tax savings. I don't know if that's worth it. Maybe.
You got to look at your divorce fees. There's there as well for that type of marriage of convenience, but that comes up a lot. So I think that's something to point out. But to chip away at that tax bill, shouldn't people keep the receipts for like improvements to the home and things like that? Like if they had to repave their driveway or fix their basement, that chips away at that capital gain number as well.
That is true, yeah. And like some of your closing costs can too. So yeah, when you keep the receipts for any improvements, that adds to your cost in the property. And then, your settlement statement when you sell the house, you want to give that to your CPA. Accountant, tax preparer, because there may be some items from the sale that you can deduct too.
Yeah, I think that's important. So while you're having this home, if you're looking at selling, a lot of people don't keep great records and can't remember what year they had to install new blinds or repave the driveway. But think about those things. Keep a little special file, tuck that away, because it could be beneficial when you sell to chip away at that capital gain tax. I always tell people it is in every legal agreement that I see as an attorney or mediator that the family law attorney is not a tax expert. And so they need to get their tax advice from a professional like Jason. And this is all that you do. For people who are approaching divorce, what other tips do you have for them about how to handle their taxes well?
Sure, yeah. Think about if you have children, how we want to handle claiming them. Typically, the custodial parent would be able to claim the children, but if you have like a split custody, that's something that you would want to negotiate. Even there's scenarios where the custodial parent doesn't have to deduct the children, you just have to agree to it. So if one party maybe had less income than the other, that could be beneficial. I deal with a lot of situations where there are tax problems, so like there are unfiled tax returns, or maybe one party is aware that the other is possibly cheating their taxes, or they have concerns.
Yeah.
There's a lot to unpack there, but I would say, normally if you have a concern and a tax return hasn't been filed yet, you can always file separately. So there's married filing joint and married filing separate. If you file joint, you are responsible for the tax liability, even if it's not your income or your tax issue. If you file separately, while you may owe more in taxes, you're not responsible for the other person's income or their actions.
Yeah.
You can amend a tax return from married filing separate to joint. So if it ends up being a mistake or whatever, you can always reverse that, but you can't amend a joint return to separate. The only way to get out of a joint tax liability is through a process called the innocent spouse relief process, which we do often. But I think if I polled all of my clients who I've helped obtain innocent spouse relief with, they would probably tell you they wish they had filed separately. I'm sure they enjoyed working with me, and we get along really well. But it is a stressful process to go through with the IRS. Anytime you're fighting or litigating with them, and obviously you're paying me, so it can be expensive. So filing separately would solve a lot of problems. The clients have come to me, they've already filed jointly. I don't have a time machine to go back and fix that. But if someone was looking at a choice prospectively, I would err on the side of caution.
Yeah, I see that a lot where somebody says, have no idea what was in these taxes. I didn't have anything to do with them, but yet they signed them and they put their signature on there for a joint return. So they're on the hook for that because they signed it, right? Yeah. So if you're presented with that, get the information before you sign it that you're comfortable with in order to execute that, because the innocent spouse, a lot of people have a misconception. It's just a form that they file with the IRS and they are absolved of responsibility, but it's actually quite complicated.
Yeah, and I think it can be easier to qualify sometimes than people realize, but I agree with you. And if you're in this scenario, the other side's probably going to want you to file jointly because they'll save money. And if you have reservations, you should make them, provide evidence so you feel better, provide proof. With innocent spouse relief, the main requirement or element that the government looks at is your knowledge. So if the other side assures you there are no problems and gives you all this information, you've set yourself up for a really good innocent spouse case, because you're going to be able to say, hey, I did all the due diligence I could possibly do. I was prudent, and I tried to obtain the information, and they lied to me, right? And,
I think it's important to note that there is still a process that you have to go through. It's not just a declaration, whereas if you file separately, you're absolved of that, but there could be a financial repercussion.
No. I mean, at a minimum with us, it's like $5,000 in legal fees, right? Whereas filing separately is going to cost substantially less, even if you're paying more in taxes. So no, for sure, it can be the easier outcome.
Another thing I have seen happen from time to time is, for example, people get divorced, a couple gets divorced in 2025, and then somebody or the marriage gets audited for 2022, 2023, and they have to go revisit all of that as a couple. Have you seen that?
Yeah, I mean, we've represented divorced spouses in these audits. I mean, you would definitely want your own separate counsel. If the tax preparer is representing the parties in the audit, that could work, but I would still say have your own separate party to make sure there are no problems. You can assert innocent spouse relief in the audit. As the audit advances, you're going to want to know, well, what is the IRS looking at? What are the issues? If it's an issue you were unaware of, like that you didn't have knowledge of, you're a great candidate for innocent spouse relief.
Sounds great. So I think if you're listening and you take nothing else away from this episode, it should be taxes are complicated. Unless you yourself are a tax expert, you should reach out to one. Before signing a settlement agreement that's serious, just have somebody look it over and spot check any sort of tax consequences to make sure that you're aware of what those are, so you understand the value now and in the future of what you're agreeing to. Jason, if people are listening and they want to reach out to you to work with you, what is the best way for them to find you?
The best way is to just call my office, 404-233-9800. Thank you so much for having me, Tracy.
And so if you're driving and you can't write that down, no worries. Just save this episode, come back, and Jason's information will be in the show notes. He is also in the Amicable Divorce Network directory. And if you have our book, Divorce Amicably, Your Roadmap to Resolution, he wrote chapter 64 and has some contact information at the end of that. Jason, thank you very much for being an expert in this field, a member of the network, and for writing this chapter.
Thanks for having me.